Today we're going to be talking about analysing and interpreting financial statements. This is where we use our knowledge about accounts in order to answer questions about the firm and to understand something about the way the firm is working. And the good thing about this kind of analysis is that we can find out things about a firm that a firm is not necessarily going to want to reveal, but remember that companies have to report their accounts and they're filed in Companies House. So as we've said before, if you Google Companies House beta at the moment, you will be taken to a site where you can download the accounts of a company for free at the moment. So you can look at these accounts and you can find out something about the company. Now, large companies, of course, produce annual reports, and they are full of analysis of their performance. So here we have Rolls-Royce accounts from the annual report for 2016, and it gives a little summary and some analysis. It talks about its gross margin, gross profit over sales as a percentage. So that's a piece of analysis there, and it's looking at underlying profit before financing costs. So it looks at the change there, and then underlying profit margin. So that's profit over sales there. So companies analyse their accounts themselves, but the good thing is we don't have to believe what they say, and you must accept that they put a positive spin on it. And company reports, which you'll be looking at, some of you later on in the course, they're full of glowing analyses like this. So underlying operating margin, and here we have net R&D as a proportion of underlying revenue, various looking at the performance over the years in this case, but it could also be between divisions within a year, and various ways of analysing the account. So it's this sort of thing that we're going to be looking at. Here are the learning outcomes that you can pause and study at your leisure. We're going to call our analysis an analysis of financial ratios. That is, for the most part, the figures we produce are going to be one figure divided by another, a fraction, which we call a ratio. And these ratios are going to be concerned with these topics. So investment, gearing, liquidity, efficiency and profitability. And each area, there is a question attached to that area. So for investment, we're looking at how does the company look to its owners, or if it's a public limited company, the shareholders. When we're looking at financial gearing, this is the degree of borrowing that a company is undertaking. We're looking at risk in essence, and we'll explain that later on. Then if we're looking at liquidity, essentially how likely are we to become bankrupt? So that's a very important topic. Efficiency is kind of judgment of management. Now there are going to be many other factors coming into these judgments, but the numbers, the accounting numbers, is a critical contribution. There's no doubt about that. And then finally, profitability. Just is the company making money? If so, how much? And we look at ratios in context. In our brief look at Rolls-Royce, we saw that they were looking at it over time. So you can look at it from past periods, answering the question, are we improving over time? You can look at similar businesses in the same period, are we better or worse? And we can look at it against some sort of budget or planned performance. Are we above what we plan to be, or are we below? In each of these, it's quite helpful, especially if you're the one being judged, because in each of these ways of looking at the numbers, a loss could still be seen as good. Our loss might have reduced over time. Our losses might not be as bad as other companies' losses. Our losses might actually be better than the losses that were in the budget. So that moves us away from thinking that profits are good, losses are bad. A profit might not be good if it is not as much as in past periods. So we mustn't have simplistic judgments on these measures. When they're put in these sort of contexts, the judgment is a good deal finer than simply saying profit good, loss bad. So we're going to have a look at each of these ratios in turn, and we start here with profitability ratios, and each ratio, as it says at the top, measures a different aspect of profit. So we have profit for the year less any dividend over ordinary share capital and reserves. So this is going to be profit in terms of the returns to the ordinary shareholder. If, however, we want to look at profit in terms of our total investment in the activity, how much money has been put into this activity, whether shareholders, whether long-term lenders, then we look at the operating profit in relation to these sources of revenue. So it's important that we have the top matching the bottom. So profit here for the year must be profit due to the shareholders, because we just have shareholders on the bottom level. Operating profit here must include the interest payments, because that's part of the monies that are due to these owners, these investors. So this matching of top with the bottom is very important. Then we have the operating profit margin, the operating profit, which is, by operating we mean the profit involved in running the actual business, and not deducting financing costs. So the profit in running the actual business as a percentage of the sales. How much of every pound sold is profit? And then the gross profit margin, this is the operating costs without the administration costs that we call gross profit, that we looked at in the profit and loss account. Gross profit as a percentage of the sales revenue. So the difference between those two is essentially the administration and management costs. So they're all very different. They're all answering different interests, and you need to be familiar with all of them. Here's a little review of the ratios. Return on capital employed for UK companies, and as you can see, manufacturing doesn't do as well as the service industry in this country. Service industries dominate. Manufacturing is, I would say, underinvested, and well, there's a whole area of analysis about productivity that underlies profitability. So it's a broad picture, but you can see over the years the UK happens to be mainly a service type economy, and that is where the profits, and I have to say that is where the jobs are as well. Efficiency ratios designed to answer questions such as, do we have too much stock? Are debtors not paying? Are we having difficulty paying our creditors? So those are questions that come to mind. And a further set of questions: are we losing sales through being out of stock? Should we be extending credit to our customers? Can we borrow a bit more from our creditors? So these are all questions that come to mind, for which the stock days, debtor days and creditor days can offer some help in making the judgment. And then we have these efficiency ratios. Are we being more efficient with our capital? Are our employees being more productive? And we were just briefly talking about that earlier. How do we calculate it? Well, it's average inventories held over cost of sales times 365. So it's the number of days which we hold stock. And, so it's the number of days that we hold our average stock. And same with trade receivables, our average level of debtors. How long does this average last? Average trade payables, creditors. How long are we taking to pay our creditors? And then we have this sales revenue to capital employed. How much sales are we generating? It'll be different in different industries, different activities. And similarly for here, sales revenue that divided by number of employees will obviously depend on things like the level of automation. So those are efficiency ratios. Let's just have a quick look at stock days. We have stock levels, and typically this is the kind of pattern where we have this kind of sawtooth pattern. Stock comes in and then is used up. It comes in and is used up. It comes in and is used up, creating this pattern. We can take in a lot of stock, and if we do, we hold it for longer. Or we can have lower levels of stock and restock more frequently. So there are costs and benefits associated with each of these strategies. Clearly it's, if we think of a shop, for example, if we go for the blue pattern, then we're going to be taking up a lot of shelf space. It might be a little bit cheaper just to order in stock less frequently. It means less movement on the shelf. But if our display area is limited, then we're going to have less room for displaying other things. If we have a more frequent stock, it's liable to be more expensive, and we're going to have more people running around filling the stocks. But we're going to have more room on our shelves for a wider range of items, so that there are benefits there. So stock days just is part of this consideration, and there are these other factors. How important is it to display a wide range of stock, and the risk of a stock out as well, being out of stock, is probably going to be greater with our orange pattern here than with the blue pattern there. So lots of management considerations, but the level of stock days is certainly something we need to have as an input. So just to put a few numbers to this, if we used 12 items, whatever, so our cost of sales equals 12. If the average stock is 4, then we've sold our average stock 3 times. We measure things in pounds rather than physical items, which is again an approximation. So our average, we've got an average stock of 4. We've used up 12 as our cost of sales. So our average stock is 1/3 of a year, right? Which is 4 divided by 12. So our average stock is 4 divided by our cost of sales, which is 12, times 365, 4 over 12 times 121 days. So our average stock is held for 121 days, and in this example you can see it's held 3 times, covering the whole year. If we used 12, same as before, so our cost of sales is the same, but this time our average stock is only 2. Then we've sold our average stock 6 times, so our average stock is now 1/6 of a year. Average stock over cost of sales is now going to be times 365 is now going to be 2 divided by 12 of 365, so 61 days. So that's a much shorter time period and doubling up the time of the restocking time as on the previous slide. So this is more the orange pattern and this is the blue pattern essentially. And it's the same sort of logic with debtors. How long do debtors take to pay? And creditors, how long do we take to pay our creditors? So that's the basic logic of the days type analysis, and it goes down very well in management because everyone can understand a day. It's a nice clear unit. Right, so let's have a look at return on capital employed. This is quite a common way of looking at it, breaking down the return on capital employed, and remember that's operating profit over long-term capital employed, that's shareholders and long-term liabilities. And it's common to put sales revenue as an intervening variable, so operating profit divided by sales revenue and then sales revenue divided by that. So that links up our sales margin with our return on capital employed, and also something that we would call turnover of our capital employed, which is not a very informative figure, I don't think, but as a sort of over time comparison, an intertemporal comparison, or sometimes called a dynamic analysis, you can see if it's increasing or decreasing and ask questions as to what's going on. And the sales margin is reasonably clear. You know, if you're selling whiskey or food or whatever, it's the how much money you're making on a bottle of whiskey and that sort of thing. So this is a way of breaking down the overall return on capital employed, so we can sort of see the relationship between the profit we're making on our sales and the sales in relation to our capital employed. Now, the other topic we were looking at was the liquidity ratio, and as we said, it was a risk of bankruptcy if we run out of money. Can we afford to pay our creditors? Well, if we can't afford to pay our creditors, then they can petition the courts for a winding up order. In other words, closing down the company. So that's why it's linked to bankruptcy. How do we measure our ability to pay our creditors? Well, there are two common ones, the current ratio and the acid test ratio. Current ratio is current assets over current liabilities. Current assets are those assets that can be reasonably easily turned into cash, and current liabilities is dominated by our creditors. So it's answering the question, over the medium term, or say within a month or so, can we get enough cash together to pay our creditors? And that is how we would measure it. Then we have the acid test ratio, then, and that is going to be the current assets that can be readily turned into cash, short term. Do we have enough cash to pay our current liabilities, our creditors? Now, the important thing to note here is that this figure varies between industries. In some cases, the current ratio may be very high, as in businesses with relatively low turnovers, and in other industries it's going to be very low. So for a supermarket, for example, the current ratio may well be less than 1. In other words, they don't have enough cash to pay for their creditors. Now that might sound alarming, but remember that this measure is taken at a certain date, at the year end, if we're looking at the accounts. And it doesn't mean to say, well, the creditors aren't all going to be asking for payment at once. and our level of current assets is like our stock of cash. And if it's a retail operation, then it's going to be replenished very frequently, more frequently than the creditors are asking to be paid. So if we kind of go back to this, if our current asset turnover is like this, right, in other words, we get quick payments, then we can pay our creditors quite easily, because it's going to be, we get a ready inflow of cash. Whereas our creditors are asking to be paid at a slower level, so we can match up a frequent replenishment of our current assets to pay our current liabilities. But if our current assets are not being frequently replenished, in other words, they're taking a long time to pay and things like that, then we need to have a much higher current ratio, and it can go up to twice as much because our debtors are taking a long time to pay, so we need a lot of debtors to be sure of being able to pay our creditors on time. We can see from the current ratio, and similarly for the acid test ratio, the payment policy and how well the company is managing its debtors. So there are a number of reasons why it can go up and down. It may be that our debtors are suddenly taking much longer to pay. It may be that we're taking much longer to pay our current liabilities. So in that case, both those figures would start to rise. Our current liabilities would be going up because we're not paying them. So they're mounting up and up. And similarly, if our debtors are not paying us, then the debtors figure is going to go up equally. We can look at these and we can start to say things about the business. Now, in your seminar, that is exactly what you're going to be doing, so do remember to attend the seminars. Gearing ratio. Now, gearing is related to risk. It's the amount of borrowing, and at the personal level, it seems reasonably obvious that if you're borrowing a lot of money from the bank and the bank is asking for interest payments, then you're in a pretty risky position. Either you're earning enough to cover those payments, or if you're not, you've got to pay the bank, and you've got to find the money from somewhere. So you're in a bit of an uncomfortable position. It's exactly the same for companies. If they're borrowing a lot of money, then they have this payment that they've got to make. In good times, that's not a problem. In bad times, it puts them in the same position as if you and I had an interest rate bill that we couldn't pay. And it's the same for a company. So I've put a few figures to this. This is low gearing, that's a low level of borrowing, medium level of borrowing, and high level of borrowing. So for the low level of borrowing, we've got our total finance of 2,000, right? Whatever it is, 2,000 or 2 million, whatever you want. But our number is 2,000. So our low level is in fact no borrowing at all. Our medium level, out of the 2,000 finance, we've borrowed 500 and 1,500 of our own. The high level of finance, we've only put in 500 and we've borrowed 1,000. So that's a high level of borrowing. And I believe some football clubs have been taken over in this manner, where the actual owner hasn't put in that much, but they've borrowed a lot, sometimes on the security of the football club. But that's a small aside. I think Manchester United supporters take note. So we've got this level of financing, and we look at two scenarios. What happens if our profit's at 500? What is the return to the owner? And what is if our profit is only 65? What's the return to the owner there? And we can look at it in each of these three scenarios. So let's have a look at the 500 situation first. So we've got 500 here, we've got no interest rate payment, so it's all due to the owner who's put in 2,000, so the return is 25%. If the owner has borrowed 500, then there's a 10% charge to pay, so that accounts for the 50, so it's 500 minus what you have to pay to the bank of 50, divided by the money you've put in, the 1,500, so that's a return of 30% on your money. And then with the high level of gearing, there's you've borrowed 1,000 to 10%, so you've got an interest rate bill of 100. You've earned a profit of 500 there, and so it's 500 minus 100. The 400 is yours, and that divided by the 500 you've put in, and that comes to an 80% return. Right, so that's a very high return. So in good times, it's definitely a good idea to have high borrowing, or you will maximize your profits. But in doing so, you risk this scenario where profits have fallen to 65. What's the position now? Well, you can see it's been reversed. Now suddenly the low gearing is getting a higher return, where in the past it had a lower return. So the 65 is all due to the owner. The owner's put in 2,000, so that's a return of 3.25%. Then we've still got the 50 bill because the bank asks for its 10% on the 500. So we've still got the 50 bill. That just leaves 15, and that leaves a 1% return. And now we've only earned 65. We have this 100 interest rate bill to pay, so it's now negative. So we've got negative 35 over 500, that's minus 7%. And so now this is the worst position. So if we look at the two scenarios for the high level of borrower, either he's going to be earning more than everyone else, or he's going to be earning less, depending on the performance of the company. So a much wider range is being undertaken here. The medium is kind of mid-range, and here we've got the smallest range. So you're taking less risk if we interpret risk as being the range of possible outcomes. We're taking less risk with the low gearing. So the level of gearing that a company is undertaking is important in making a judgment about the risk that the company is facing. And it's one of the elements of the risk. How do we measure this? Well, it's relatively simple. Long-term non-current liabilities, that's what we owe to bondholders and the like, long-term loans over 1 year, over all the finance that goes into the company. And so that's essentially the percentage of finance that is sourced through liabilities, owings that demand an interest rate. We can look at it on the payment side. Operating profit is the money available to pay interest over the interest that we actually have to pay. So that is another way of looking at it, and it's called interest cover ratio. Here we have the investment ratios, keeping your owners happy, and again it's a similar sort of thing. Dividends due to the owners over those who are going to be dividends announced for the year over our ability to pay those dividends, and we can reverse it and call it dividend cover. And often it's presented in these two ways. Ratio one way, cover is just the reverse. And dividend yield is looking at the dividends over the current price of the share on the stock market, and that is the stock market's valuation. So that is some measure of the kind of return that the shareholder is getting as an investor, and the shareholder has to buy the share in the market. And then continuing this, earnings per share, again, it's a measure of how profitable the company is, but it's got to be earnings available to ordinary shareholders over the number of ordinary shareholders. So again, we must match the top with the bottom. Then price earnings ratio is a very common figure that has to be prepared by the larger companies. The market value per share over earnings per share. So how many years of earnings does the current market value represent? And the PE ratio will vary between businesses. If the business is high risk, then we'd probably expect a lower PE ratio. In other words, the price just represents 1 or 2 years earnings because we're a bit uncertain about the future. If it's a very safe company such as utilities, then it's going to get a very high PE ratio because it's relatively safe, and therefore the value of the company will be a number of years of its future earnings, or of its current earnings. Right, well, do take a pause if you want a bit of a break, but we're quite close to the end, so I'll carry on. Have a look at these. These are dividend yield ratios, how profitable in different industries. So dividends divided by shares. High is highly profitable. Low is a low level of profits. The kind of question is, why aren't they all the same? And it is quite a difficult one to answer. Dividends are not the only form of return. Share prices can increase in future, so you do get the increase in price of the share. So you might be investing in a company that's not paying a high level of dividends, but the share price is going up because they're retaining their dividends and investing in the business, and you're getting a return through the consequential higher share price as a result of its investment. I'm not saying that that is the explanation for these figures, but that in theory at least sounds like quite a good argument. But there's also the marketplace. Some may say that the electricity and the service supply industries are in a monopolistic market and are making money hand over fist, so they're making excessive profits, and that there's not enough competition in these markets. Similarly, banks have been accused of being excessively profitable. So these figures could be a comment on how competitive the markets are, and for market inefficiency in effect. So we must always be very careful in interpreting figures. You must always use cautious words, might be, possibly. Those kind of phrases should dominate your analysis. Average price earnings ratio, this is what we were talking about earlier, and you can see that some industries considered relatively safe, apparently, or that have prospects of very high pricing. So again, this is not easy. Food products probably are on relatively safe ground. These companies, the demand for food is not going to suddenly diminish, so there's a guaranteed revenue, and the market price of the share is going to be a multiple of earnings. Now, why is it so high for pharmaceuticals and biotechnology? Well, for a different reason, really. These companies are investing in research which can transform a share price. So there's the possibility of an extremely high share price in the future, and the current price is kind of discounting that, so it might not be earning very much because it's investing in a lot of research and development, so the PE ratio can be very high. And so those are the kind of two extremes of the arguments, and some businesses are relatively risky apparently. Electricity earnings, how does that match with this? We've got dividend yield over, so we've got high dividend over the share price, so it's paying out a lot of its earnings as dividend, meaning that it has a high dividend yield ratio, and its PE ratio can still be relatively low. So it's not a simple calculation, and as I say, you should be very cautious, as I have been, in stating why a figure is as it is, and you should always kind of have a sentence to the effect that further research is necessary. If we look, retail industry is a very common one to look at because everyone's familiar with it. I'm not sure if that isn't a disadvantage actually, but never mind. We can see the current ratio, and as we were saying earlier, in the case of the retail industries, it's less than 1 because its assets are turned over. It has a high turnover of its debtors. I mean, most of the sales are in cash, so it doesn't need much by way of debtors anyway, but it can keep its cash levels relatively low and pay its creditors frequently because it's getting a regular supply of cash. So its current ratio would be below 1, and this is to counter what historically has been a problem. People studying it seem to think that all businesses should have a current ratio of 2 to 1. That is just not true. Limitations of ratio analysis: quality of financial statements. They are audited. Some may be, you should be looking at audited statements. Not always, not in every situation within a company. It might not be the case. The effect of inflation, that has not happened for many years, but clearly if prices are going up by 25%, as has happened in the UK, then comparing this year's figures with last year's figures is problematic. Ratios, as we've been saying, is only part of the questions that we're seeking to answer. There are issues to do with the market, there are issues to do with the type of industry, and so we mustn't draw strong conclusions just by looking at the ratios. And as a basis for comparison, well, it depends on how good our other figures are, that sort of thing. And the statement of financial position, whenever we're using a balance sheet, we must be careful about the problem of what's called window dressing. In other words, they may have got their debtors to pay early through special discounts at the year end, so that their debtors figure looks very low for the year end, but that is an exceptional figure, and that the day after it may be that figure suddenly rises as the debts are kind of brought back onto the balance sheet. So we won't go into the technical details of that, but you can make your balance sheet look good for over a particular period. As I say, a very simple one would be offering huge discounts to your debtors so that they pay up, and in that way make your debtors look artificially low and hide the fact that you've got a bad debt problem. Analysis of accounts is something done at the small level and at the high level. Here we've got an article from the Daily Telegraph, and it's the Bank for International Settlements that looks at the world's banks going through their accounts. They suddenly find that there's a lot of hidden debt on the balance sheet in the form of, no, not on the balance sheet, in the notes to the balance sheet in terms of derivatives. Derivatives are promises about the price of a future currency or asset or whatever, and it's a bet, and your bet can be earning money or in the money, or it can be out of the money. It's a bit like an ongoing horse race, if you like, only the race hasn't finished, so you don't actually owe the money, but your horse may be so far behind that it's almost certain that you've lost your bet. So it's these kind of conditional, contingent situations that this is talking about, and it finds a huge amount of potential payments that are hidden away in the notes, because these liabilities, these out of the money derivatives, haven't actually matured, so that the horse race hasn't finished, as it were. So these kind of subtleties are constantly happening, so don't believe that everything has been solved. It hasn't. This is an example of an ongoing problem. I would encourage you to look at some accounts and see what you can tell about the company. As I said before, you are doing this in your seminar session. So for this question, 6.3, use 6 ratios to comment on profitability and efficiency ratios of the business. So you look at this and you apply the ratios from the lecture, and it says comment on the profitability. So that gives you an opportunity to say something about the ratios in the cautious manner that I hopefully have been conveying to you. And then for 6.4, you have a list of ratios that are asked for, and again a comment on the performance. And again, you should provide a reasoned summary and comment on what these ratios mean. Okay, so that concludes our look at interpreting financial statements. There are other aspects to it, but ratio analysis, which we've concentrated on, is certainly the major part.